Thank you for watching. When it comes to retirement accounts, one topic is often debated. Which is better, a tax-deferred traditional IRA or choosing a Roth IRA? I've read many posts online and watched videos produced by professional financial advisors, and there are lots of opinions. One thing I've noticed is the lack of any data or empirical evidence to support those opinions. I hope to give you something more substantial to consider. I intend to offer you an analytical perspective based on my years as a market analyst and my 10 years as an IRS-certified tax preparer. It's important to remember that the choice between a traditional IRA or Roth IRA is purely a tax question and not an investment decision. A little history might be of interest here. The original IRA that we now call the traditional IRA was created in 1974 and designed to enable companies to discontinue lifelong pensions for employees. Employer contributions to an employee's IRA were much cheaper than fully funding a retirement pension. Employees were incentivized by a tax deferment of contributions, the market growth of those contributions until withdrawal during retirement, and the probable loss of retirement income if they did not start putting money aside for their own retirement. Jump forward 20 years. The federal government is having its perpetual argument over the deficit. Wanting to increase tax revenue without raising taxes, the Senate Finance Committee, with Senator William Roth from Delaware, sees the Federal Reserve report showing trillions of dollars in pre-tax retirement accounts, and they wondered how they could tax some of those savings. The Roth IRA was born and enacted by Congress in 1997, offering to exchange the tax model from pay me later to pay me now. The tax laws are more complicated than what you see here, but these are just a few of the distinctions. Notice the bullets about RMDs, required minimum distributions, because avoiding RMDs is often cited as a reason to choose a Roth. What they always leave out is that for people born after 1960, the annual RMDs don't begin until they reach age 75, and they start at about 4% of the annual account balance. You'll see one example of the tax difference in a bit. In theory, how you choose to invest your retirement savings would be the same whether in a traditional IRA or Roth IRA. I've watched a few videos on this topic and read many articles. The videos and articles all seem to say the same thing and have the same thing in common. They don't support their positions with any analytical comparison of the tax differences between Roths and traditional. I find that odd since this is a tax topic. I build my own financial models to estimate financial outcomes, but they do have limitations. The challenges for estimating outcomes are these. While this is a tax question and not an investment decision, your investment choices affect your account growth, which ultimately affects your taxes. We cannot estimate how much tax anyone would avoid in their lifetime contributions to a traditional IRA, nor similarly can we estimate the taxes paid on a contributions over a career into a Roth IRA. But that's the whole context of pay me now versus pay me later. We can use national statistics to estimate your life expectancy when you actually retire. And while we don't know how much you would withdraw each year during your retirement, we can look at example variations. Every tax season, I see that most retirees have multiple income streams which affect their actual effective tax rate each year. We did not model most deductions or any tax credits, but we did model income using notional values. In the next two slides, we show an example tax return for a couple, both over 65, with multiple income streams, including the same annual distribution, one from a traditional IRA and one from a Roth IRA. This is as close to an apples to apples comparison as possible, given what cannot be modeled. Our first example estimates federal taxes on a traditional IRA distribution. This scenario applies equally to an IRA, 401k, 403b, and government thrift savings plan, or TSP. This scenario assumes both are over 65, and they get the standard deduction and the new additional senior deduction. We assume they have one IRA with a balance of $750,000. According to the U.S. Treasury, the median balance for those 60 to 70 years old is approximately $200,000. For this scenario, we assumed they followed the recommended 4% annual withdrawal rate, which would generate an annual distribution of $30,000 from their traditional IRA, which is highlighted in green. Scanning the list of income sources on the left side, you can see we used values for the most common types of income we see on tax returns. You can see this couple's gross income was $150,720. Most people will have some of these, but not all of them. For estimating the federal tax and effective rate, we treated all income as ordinary income and used a tax estimator. Notice the tax amount and the effective tax rate in red. We used the 2026 marginal tax brackets in our model to estimate their federal income tax, which was $12,173, resulting in an effective rate of only 8.08%. Now let's look at the same scenario, but where the $30,000 distribution came from a Roth IRA. As you can see, all the assumptions at the top are identical to the traditional scenario, both over 65, a single IRA with a $750,000 account balance, 4% annual withdrawal, and the same standard and senior deductions. All the income sources are the same amount, resulting in the same annual gross income of $150,720, highlighted in green. Now, because the $30,000 came from a Roth instead of a traditional IRA, the $30,000 is deducted from the gross income, resulting in a taxable income of only $120,720, which is also highlighted in green. Using the same federal tax estimator model, you can see the estimated federal income tax is $8,302, resulting in an effective tax rate of only 6.88%, which is 1.2% lower than the 8.08% you saw on the previous slide. An effective tax rate difference of only 1.2% for a couple in this income level is not compelling to putting retirement savings into a Roth instead of a traditional IRA, especially 20 or 30 years before retirement. In my view, if a reasonable estimate of taxes avoided on contributions to a traditional IRA cannot be compared with potential taxes paid on contributions to a Roth IRA, that further puts the choice of a Roth IRA into doubt. I said earlier that this is a tax question and not an investment decision, but your investment choices ultimately affect your account growth, which ultimately affects your retirement income and taxes. The next several slides are about some of the investment options and their consequences. Under the title of this slide, you can see a notional timeline for the phase of your working career and a generalized statement about typical income over that career leading to eventual retirement. Your income in retirement depends on the income streams from sources you saw in the previous scenarios, plus the results of your investment choices, whether Roth or traditional. If you allow a financial services company to manage your retirement account, they will use an age-based chart similar to this one to continuously rebalance the assets in your portfolio as you get older. Rebalancing is typically done quarterly, and as the blue text states, rebalancing means selling your stocks or stock funds to buy more bonds and eventually increase cash as you approach actual retirement. While the percentages will vary from one company to the next, these numbers are fairly typical across the financial services industry for assets under management. Automated rebalancing to achieve target percentages of assets are done using target date funds, and we'll look at one example in the next slide. I thought it might be useful to show how one of the major financial companies handles retirement assets under management. I took this color graphic off the Vanguard website. For presentation purposes only, I added the bold text on the graphic from Vanguard's text immediately below their graphic. The yellow banner at the bottom is mine. First, notice the timeline at the bottom spanning from 20 years of age up to 95. The Vanguard glide path, where they begin reducing stocks and increasing bonds, begins at age 40. Notice that the stocks are at 90% of the portfolio at age 40 and are continually reduced down to 30% by age 72. Also notice they begin incorporating short-term TIPS or Treasury inflation protected securities at age 60 to begin providing cash for withdrawals. Vanguard is fundamentally no different than Fidelity or Fisher or Raymond James or Charles Schwab or Wells Fargo in how they do this. All the financial services companies offer this option, while the numbers on each glide slope for their target date funds will vary. They all seem to start reducing stocks for bonds at age 40, a whole 25 years before a standard retirement age of 65. Some reach their bottom target allocations at different ages, like Vanguard. Example, the government thrift savings plan reaches their target bottom at age 65 with only 26% stocks. By comparison, Vanguard shows 50% stocks at age 65, and their bottom is 30% at age 72. While this strategy for retirement accounts is widely accepted practice, it stifles reasonable growth prematurely. This methodology is contradicted by analysis of census data, IRS data, and market trend data. Let me show you what I mean. If all the financial services companies, which includes banks, investment companies, and insurance companies, are managing your retirement account using an age-based paradigm that reduces your growth assets starting at age 40, how much growth are you forfeiting by letting them manage your account? I got this chart on the cdc.gov website in a data brief from the National Center on Health Statistics. The top half shows life expectancy at birth by gender, and in 2024, it ranges from 76 to 81 years for males and females, respectively. That's more than 10 to 16 years past the target retirement standard of 65. The bottom half of the chart is even more interesting. For people who actually reach the age of 65, their life expectancy in 2024 is 18 to 20 more years for both males and females. If this is the life expectancy in the US, Why would any financial services company or insurance company say you need to begin mitigating your financial risks starting at age 40, 25 years before your future retirement, and then offer to do that for you? Is there something they aren't telling you? Remember those additional years in life expectancy above when we look at the next slide showing performance of various major benchmarks over time. Back in 2005, I built my first market data table showing the annual change for each benchmark at the end of each year going back to 1994. Each January, starting in 2006, I added the annual change for the previous year to the table. The table is too long to display, but you can see the row for 2025 for each major index used in many or most retirement accounts. While each financial services company probably has a fund that tracks the S&P 500, there will be a slight difference between the performance of their fund and the actual index. After updating the table each January for the previous year, the table recalculates the average return rates for each benchmark for the previous 5, 10, and 20 years. The CPI-U is the benchmark for inflation from the Bureau of Labor Statistics and shown on the right for comparison. So, some rhetorical questions for you. If you think you have 5 years to live, not 5 years to retirement, but to live, looking at those indices along the 5-year average line, where would you want your retirement funds invested? If you thought you had 10 years or 20 years to live, not to retirement, where would you want your money invested? The point of this summary table is to show the long-term market performance over time that includes in those averages the down years of 2008, 2018, and 2022. When looking at market history using a long-term lens, those down years are invisible. This data, combined with the life expectancy statistics, illustrates the contradiction from professional advisors that you should become more conservative based on your age in proximity to retirement instead of proximity to your life expectancy. I have one more item to drive home this point. I built this graph using my 1994 to 2025 data tables for those 6 stock and bond benchmarks. I entered $100 for each benchmark starting in January 1st of 2006, and it showed this for a comparison of performance over the past 20 years. The S&P 500 index is the red line in the middle. I fully understand that most 401ks or 403bs with financial fund managers, insurance companies, and the government thrift savings plan do not have a NASDAQ 100 index or NASDAQ composite index fund. People with an IRA account with a full service investment broker typically do have access to these types of funds. Because the y-axis is in dollars, not percentages, you can see how the dips for 2008, 2018, and 2022 differ in the magnitude of change. The change for 22 was a smaller percentage than in 2008, but because the absolute dollars were smaller in 2008, it barely registered on the graph. But look what happened after the drop of all the funds in 2022. The rewarding bounce for those who did not sell or panic was huge. The point of this slide is to show a few things. First, the NASDAQ funds outperformed the S&P 500, the U.S. completion funds, and international funds. It's been doing that for over 30 years. Second, financial advisors who consistently encourage people to move from stock funds to bond funds denied those people the immense growth they could have had. Finally, this chart shows if you stay the course over 20 years and ignore the noise going on during each year, even the big losses are temporary, and the bounce always rewards those who don't panic. Each tax season, I've done tax returns for a few seniors who came in proudly proclaiming they had converted their traditional IRA, 401k, or TSP to a Roth. Some were in their 70s. Naturally, once someone does convert, that cannot be undone, so I say nothing. When someone comes in and tells me they are thinking about converting their traditional 401k or TSP to a Roth, then I talk to them about some things and ask them questions. There is a conversion cost that is taxed this year on all the tax deferred contributions and growth spanning their working life. When combined with other income streams, like you saw on our earlier tax examples, converting both personal and matching contributions, plus all the growth over time, will likely have their income taxed in a much higher marginal bracket. If they choose to pay the income taxes on the conversion from the traditional account, that tax amount is also considered a taxable distribution. There are the 5-year rules like the ones shown here, but they come with conditions, and there are exceptions to almost every rule. The one part that most people do not readily grasp is that once converted and taxes paid on the converted amount, only the growth of the converted amount is tax-free. The length of time those funds are invested and how those funds are reinvested determine any potential tax benefit in the future. Remember how financial advisors and insurance agents recommend you invest your money when you are close to or in retirement? Personally, I cannot imagine much, if any, financial benefit because growth is severely stifled. That brings me to how I process what I've discovered over the years and tried to show you in this presentation. I spent weeks thinking about how I might summarize my conclusions and thoughts about what I gathered on this topic for myself. If you can, pause the video for a couple minutes to read this slide before clicking on continue. Here's how I distill what I showed you. If the total taxes avoided over a career on contributions to a traditional IRA cannot be quantified, and similarly, the total taxes paid over a career on contributions to a Roth IRA cannot be quantified, and as you saw, the comparison of taxes between the two is small when withdrawn gradually during retirement. Then how can anyone say with certainty one is better than the other? But if you kept a traditional 401k, 403b, or TSP and received matching funds, then the total deposited into the traditional was more than a Roth, and the resulting growth increased your eventual retirement income. Roth accounts do not get matching contributions from employers, which ultimately reduces the amount of growth and retirement income. When I was reading the history behind the Roth, I saw they were looking for ways to increase tax revenue without implementing a tax increase. They concluded that pay me now in a Roth was better for the U.S. Treasury than pay me later in a traditional IRA. If they were right, why would you think you would be better off? Let that one percolate for a while. Your retirement account, whether it's a traditional or a Roth, is your retirement investment. I've heard a lot of opinions on this topic from people claiming this is a no-brainer, but I certainly do not think it's that simple. There is only one purpose or goal for investing your money in a retirement account, and that's to have the most income during your actual retirement. Candidly, if having higher income means paying extra tax, then give me the higher income every time, and I'll deal with any tax consequences. The example slides showed the difference is minimal. I'm a hardwired analytical person, so I like seeing numbers. I do not automatically grant credibility to anyone, including certified financial planners or financial advisors, who argue their opinion without numbers. I take crowdsourced opinions on Facebook with a grain of salt because they are typically offered by and popular with people without financial experience. What do I have that most others don't? I have personal experience in investing for my own retirement. I've kept detailed financial data about my own financial history that goes back to 1993. I have an executive program MBA degree, and I've been a market analyst for 25 years. I know the consequences of every financial decision I've made, and I have documentation of those consequences. Financial advisors who are still working for investment firms or insurance companies are giving advice based on theory and company policies. I wish you all the best as you continue your investment journey towards your eventual retirement. Thank you for watching this video. If you found this video useful in helping you think through your decision between a traditional or Roth IRA, 401k, or thrift savings plan, please hit the like button